Another item discussed in Chapter 19 is the effects of transfer pricing on division performance and how we evaluate divisions. So when we look at transfer pricing, companies have many different options. They can come internally from their organization or they can purchase outside. So we have a company that has three divisions: industrial, commercial, and consumer products. So we're looking at the commercial. The commercial division purchases 10,000 units from the industrial division. We're growing and we need 15,000 units instead of 10,000 units. The problem is that the industrial division is at full capacity and they don't plan on growing. So we can buy the division from an outside company. Okay? The industrial division is currently buying 650 units of a part called 88461. So the industrial division's sales to Admiral would not be affected by the commercial decisions regarding part 23671. So we're looking at part 23671. So when we're looking at what is the proper decision regarding where the commercial division should purchase the additional 5,000 parts? Well, those 5,000 parts can come from three different places. We can get them from the industrial division, we can buy from Admiral, or we can buy from Advanced Micro. So we see that the micro price is $200 and the Admiral Electric price is $210. So if we assume that we're buying from the industrial division, they're at full capacity. So we have the current price to the commercial division that we're being given, the variable manufacturing costs, and the price that they can pay to outside buyers. So because they're at current capacity, or at full capacity, and we're demanding more, we're not going to continue to get that transfer price of $185. So therefore, our best transfer price is to use the industrial division's $205 outside market price. We can really only justify non-market price for transfer costing if there's not an outside market and the division's not at capacity, like we're not competing with their demand. So under option 2, we're assuming that the industrial division's sales to Admiral would be canceled if our commercial division does not buy from Admiral. So when we're looking at, do we pay $205 internally to the industrial division? Do we pay $200 from Advanced Micro or $210 from Admiral? Well, the best option for the commercial department is to pay $200 from Advanced Micro, outsource the entire production, not get any more from industrial. However, if we do that, then Admiral has said that they're no longer going to be our customer. So right now, we're selling this part to Admiral. We're selling 650 of them. They're purchasing 88461, which we're selling for $95. So we're going to lose that income for the industrial department. So for the benefit of the company, it would be better for us to then purchase from Admiral. And 3, what are the strategic implications of this decision? And how can we become more competitive? So the decision to have our commercial division buy outside is good for our strategy. So that's We're decreasing the reliance of the commercial division on the industrial division, especially since we're unsure about the growth potential currently of the industrial division. And right now, outside sales of the industrial division are quite strong. So it's better for us, again, to buy parts outside than it is for us to force the industrial division to supply us. So potentially, our best option is actually to invest in the industrial division that's already at capacity and we have increased demand for. In this transfer pricing option, we're looking at the income tax effects of an international transfer. So international transfers are treated a little bit differently than transfers within divisions in the same organization that are in the same country. We have to pay taxes, imports, tariffs, and other fees on goods that we transfer in and out of countries. So the very first thing we're asked to do here is what is the company's combined after-tax income for this transaction? So we have country A, country B, and then our consolidated effects. If you remember from the reading, the revenue and the cost, the transfer price nets itself out. And so we don't see this internal transfer when we have our consolidated financial statements. So for country A, our revenue is $200 when we sell that piece to country B for further work. So we have a revenue of $200. We have a cost of $100. So we purchase $100 worth of goods, we repackage them, export them, and sell them to country B for $200. So our cost is $100. So our income on that product is $100. In country A, we have a tax of 20%. So we take the 100 times our tax of 20%, and our after-tax income is $80 per unit. In country B, we have revenues. So country B sells outside for $300. So remember, the revenue from the transfer is not considered. It's only the sales to the outside organization that appear on the to outside customers that appear on the consolidated financial statement. The cost to country B is the $200 revenue from country A. That's the transfer price. The cost for consolidated is $100. So remember, we don't show the transfer price effect at all in our consolidated financial statement. The income tax in country B is 60%. So we have an after-tax income of country B of $40. Our entire income tax effect is $80. So we have after-tax income of $120 on this transfer price effect. Number 2 says, consider now a transfer pricing approach in which the subsidiary sells the good to the parent company for $280 instead of that $200. So we're just changing the transfer price. So we change here 280 and here 280. So what we see is a change in the income tax effects. So we've reduced, so if you remember, the original income tax was $80 per unit, and the after-tax income was $120 per unit. So we've reduced our income tax effect and raised our after-tax income. So then what's the question when we're looking at, so what is the effect of the transfer pricing decision when income tax rates for the two countries in question are equal? Then it doesn't matter. We don't have tax benefits from making income tax or a transfer price decision. It would have no effect on the tax paid on the entity as a whole. For multinational transfers, there are laws against using transfer rates just for the benefit of paying lower income taxes. So what those rules state is that the transfer price has to make sense to a third party. So it has to be comparable, or what's called an arm's length transaction. It has to be comparable to either market rate or what a third party would charge, or a cost plus markup. And so this is to stop businesses from choosing transfer prices that only give them tax benefit.